Hello everyone, welcome to Just Invest Today, and today we're talking about Mohnish Pabrai, man. He did a question and answer session at Oxford University, and it was amazing. There is so many gems in it. So we're gonna get into this video. We're just gonna go down the main topics that I want to talk about in this video. There was a lot more, but if you want to go through that, just go through this video and listen to the actual source, Mohnish Pabrai, talk about it. But I want to go through my biggest takeaways from this interview. And it's important because there's so many tips, strategies, lessons in this interview that I took from it. So the first part of this interview, he just basically talks about his book, The Dondo Investor, and how we can learn from the Patels. And remember, the Patels were from, they were at East Africa. Got kicked out. They became refugees, and this is a story that he tells. And they ended up actually coming to America and being so dominant. They're only 0.2% of the population, but they own 70% of the motels in the US. So basically, it was like, how is this possible? How did it become so dominant? And this is an amazing investment lesson to everyone, man. And this is what I took to heart when just listening to the story again. Even though I heard the story before, but just listening again makes a lot of sense. And basically, he just said like these motels were basically the low cost producer. So they had a family run the hotel, and they had no payroll. So all their expenses was very low. They were vegetarians. They didn't go out shopping crazy, do anything like outside of the ordinary. They just stayed at the motels. They lived there. The expenses was low because it was just family, so no payroll. So they were out competing on price. They were the lowest cost producer. So the rooms were at cheaper price. So all the rooms were always occupied compared to the competitors, which if they actually reduced their pricing, they'd be either losing money or probably like breaking even. So at the end of the day, these guys were making money as a low cost producer and having that huge advantage. So that huge advantage allowed them to reinvest their money at a high rate. So they took their money out of that motel once they made crazy amounts of profits from just all the occupancy, all the new customers, because they're the low cost producer. They moved that family to a new motel and just did that whole process again. No payroll, just the family operating the motel and just putting low prices on the rooms, and everyone would go there as the low cost producer. And that's how they continued their dominance, and they became 70% ownership of the US like real estate, motel real estate operations. So that's just crazy to really think about, man. And that's a huge story. And he just relates it to Geico as why Geico has been so successful because they were the low cost producer. And when you think about motels or you think about car insurance, you're always going to think about the low cost producer. You don't really care about the company or the motel. Like you're just looking at the lowest cost in the area for motels for insurance because they all kind of do the same kind of things, right? So that's a very amazing story, man. And that's the importance of just finding companies with moats, man. Like don't like just don't get out of that sphere of finding companies with moats. You gotta make sure your company has a moat. Like don't sacrifice on moat. Sacrifice maybe on the price of the company you're willing to pay. Having an edge in one of these companies is super key, especially because we cannot predict the future. The future is so unpredictable. As long as there's a moat, and at least the moat kind of provides some kind of business safety that it's going to be able to generate returns in the future. So that's very key. Like, don't sacrifice on the moat. Sacrifice on maybe the price you're willing to pay. And that's what I'm kind of taking away from this because he also talks about Peter Lynch kind of released a video, I think 5 years ago. He talked to Stanford University about competition is for losers. And honestly, I'm going to go back. I'm going to watch this video. I think I watched it like a long time ago, but I'm going to watch it again. And this is such an interesting concept because he's saying that basically there's like two types of businesses. There's businesses in monopolies, the one percenters, and then the other 99% of businesses are in tough businesses. So you want to like stick to the companies that are the monopolies, and the monopolies usually tell you that they're not monopolies. Like they don't want to get all that like access, all that like people and anti-regulation and monopoly stuff on them, so they don't want to get all that attention. So the monopolies are going to tell you, no, we're not monopolies. But the tough businesses, 99%, the tough businesses are going to tell you that we are the best business, come invest with us. So we're trying to find those 1% businesses, man, right? So that's super key, man. We want to find those 1% businesses that we can invest in so we can stay in it long term. So another question that was asked during this interview was, is it easier to find the 1% businesses that I just talked about? Are markets more efficient? He's basically saying that finding good, strong businesses with an investment edge, a moat, a monopoly, whatever it is, at a reasonable price, and just good things will happen with your investment. Good things will happen over 5 to 10 years. So that's what we want to find. And he said that finding these businesses isn't too hard. Like it's very doable. Like we know, and this goes back to Peter Lynch. Like invest what you know and what you see. Like the companies that are monopolies are the companies probably that you use every day, all the time, that you see constantly people talk about, people using. Like he's talking about, oh, are you using an iPhone? It's probably a monopoly. Do you use Amazon a lot? It's probably a monopoly. Who sends you your bills for your phone or whatever service you're using? It's probably a monopoly. So just looking in your sphere or what's around you, they're probably monopoly businesses. So that's not the hard part, right? And even if you don't find it that way, just looking at the numbers of the business and how like much revenue it's generating, how much net income, return on equity, you can see if this business is a monopoly, how dominant the business is. So that's how you can just see and look at the sphere of what's around you and find out if these businesses are monopoly. But the crazy thing is about this is that we can find these businesses, but that does not mean it's a good investment. And that's why we always got to get a good price to pay for these businesses. So it's not all about just finding the good, strong companies. Anyone can do that. It's about getting in at a reasonable price. And that's the thing that we really got to do. And then he quotes Charlie Munger with this amazing quote: why should it be easy to get rich? And that's just an amazing quote. Like, why should it be easy to find monopoly businesses that are going to succeed 5 to 10 years out and buy them at a reasonable price? It's just not going to happen. So, in my mind, this is where we wait for these opportunities to buy. And this is when we have to be very patient and just wait for the market to give us one of these businesses on sale. Like, look what happened during the whole March pandemic. Like, look what happened. Like, they gave us Google on sale, they gave us Amazon on sale, they gave us so many of these strong monopoly companies that we know are successful or going to be successful. They gave us huge opportunities to buy into these companies and just hold on, man. So we just have to wait for those opportunities to give us these amazing prices to buy. So the next question that was asked was, has it become easier or harder to find great investments 10 to 15 years ago? And then basically he was just talking about like as long as there's humans in the market, humans making decisions in the market, it doesn't really matter. It like people are gonna go from euphoric highs to pessimistic lows. So just understanding that concept of just Mr. Market and how people are crazy. There's always gonna be bulls and bear markets. It's just the natural vicissitudes of the market. It's gonna go up and down. So there will always be opportunities. You just have to be patient. Like patience is so important because the market will give you the opportunity, but are you going to take it when that happens? And that's the key question. There can be a short-term problem in that company. There can be crazy things attacking that company that can put it on sale, whatever it is, or the market just all goes down. Whatever it is, there's always going to be some opportunity in the future to buy these monopoly companies on sale, right? And that's what we're looking for. We're looking for cinches. Warren Buffett, Charlie Munger always says this. We're looking for cinches. Companies are just know right off the bat they're easy to invest, man. And then he talks about basically racist and how racist is a bargain and how he bought it at like 4 cents on the dollar. And this is interesting because Racist is one of those companies that it was an amazing company. Like everything looked perfect, but it was so cheap, and you have to question it. And that's the thing about investing too, because you're gonna see sometimes these crazy opportunities, and you're just like, wait, why is this on sale? Like, why is this happening right now? Because wouldn't someone else find this company? Wouldn't someone else buy it? And that's what like Mohnish Pabrai went through when he's looking at Racist and how cheap he could get it. And he still said it can 6x in the future, so he's not even done with Racist, and he's already made 6x on his money, and he said it can 4 or 6x from here, and it's still growing its intrinsic value. So you have to just do the research and making sure that company is actually legit, and the short term is just a short term problem or whatever is wrong with that company to put it on sale. You just have to do your due diligence. You have to do your research and find out what is really going on here. Exactly. You can just go to Baba. Look what happened with look what's happening with Alibaba right now. Like we understand why it's on sale. We know this company is a $300+ company. Like no one has to do some hardcore research or some look for hardcore numbers. And we understand the short-term issue going on in China right now, the political risk, the VIE structure risk. We understand that. So are you willing to invest in that security knowing those issues? And that's how we got to invest, because we know Alibaba is basically a monopoly. Like they got charged, they got fined for doing anti-monopoly stuff. So we know how dominant Alibaba is, but are you willing to take that risk of buying into the company at this cheap price? Who knows? You do your own due diligence, but same with Mohnish Pabrai. Was he willing to take the risk of buying into Racist because it was so cheap, and he just didn't understand why, and he was doing all his investigation, so he just bought into it knowing that there's nothing wrong and people are just escaping the Turkey market because of the dollar and inflation and all those kind of macroeconomic stuff, but that didn't affect Racist the company. So that's how you got to think about it, and that's how we got to invest. You find these monopoly businesses that go on sale. Somehow, some way it does. You just have to wait and be patient and wait for the opportunity to buy in. So then he talks about shorting. He's like basically saying shorting is pointless. You only can make 2x on your money. So it's just pointless to short. You can only make 2x, but you can lose so much. So why are you shorting? He talks about the inner scorecard, and basically like you could be up 40% for the year, up 50% for the year. And then your outer scorecard, everyone, if you're outer scorecard, you'd be like, yes, all the success. Everyone's telling you, yo, you're doing a good job, whatever, blah, blah, blah. But you have to look inwards and say that, like, how much risk did I take? Am I doing everything I can, like, to like make sure I get these strong returns and I'm doing it safely? Like, you gotta look inwards and just not always focus on what people are saying to you and the praise, because that could kill you. What if you're making these returns but you're taking a lot of risk, and that might bite you if you just look to the external praise and you take that but you don't look in to see how are you actually doing and what is your actual mindset. So that was a really good talk. It talks about basically Richer, Wiser, Happier, how he changed his whole mindset from actually looking for those bang gram opportunities to now he's focused on Nick Sleep and buying these long term compounders that you don't have to make a lot of moves. It's like you don't care about that. You just invest and it's gonna explode 5, 10 years from now. You know they have a monopoly, they know have a strong company, and yeah, basically he's just talking about that and how he's switched his mindset. He also talks about cloning, which just reinstates our mind that humans don't like to clone, they don't like to copy, which is a very interesting case for him. But he says that when he clones, he is looking, basically when he clones, he's looking at the portfolio of people that are like that just made an investment in whatever company. But that's just the beginning point. That's just to filter out a lot of companies, a lot of stocks. It's just to get us a better view of stocks to buy or potentially buy, because there's 50,000 stocks in the stock market. Like, we want filters. We want a way to slim that all down. So if you follow 5 of the best investors, you can get that all down, man. And that's a crazy filter to have, especially when you know like Warren Buffett did his due diligence on the company and probably thinks it's cheap. So you still have to do your due diligence and understand why he bought it, maybe what you think about the company. And if you can find out if this is still undervalued in your mind, then buy it. It's just a way to filter in companies to buy. So that's not the end all be all. And then another question was about investing decisions and if investors are lucky since most investing decisions are wrong. So this is a good question, and it's basically talking about a lot of these investing decisions, investments, and did people lose their step because they're not winning as much? And basically, Mohnish Pabrai said that it doesn't really matter, man. Like, the thing about investing is that like you can make a lot of mistakes. He talks about Warren Buffett, like he made 100 acquisitions, and basically he said like maybe half of them failed, but it didn't matter. Warren Buffett still became the wealthiest man. John Templeton said like out of 2 out of the 3 stocks you gotta buy, like they're not all gonna do good. Like you might have a 65% rate. Like you might do good 65% of the time, like the success rate, but the other percent you might do bad, and that's on the high end, right? So John Templeton, Warren Buffett, they're losing 50% of their bets on these stocks and they're still coming out wealthy. So he's just basically saying be patient, stick to your circle of competence, and you only have to get like 4 or 5 companies to do very well, but you gotta hold on to them. That's the thing. You gotta hold on to these big winners and get all those gains, because if you hold on to those big winners, they're gonna make up for all those losses that you might have had. You might have like 90 losses, but just you had one amazing Amazon stock that returned that did like 100x or whatever, and it made up for all of those losses. So that's an interesting game about investing. You can lose a lot and still come out a wealthy man. So that's something to take into like account. Stick to what you know, be patient, stick to your circle of competence, and even if you get wrong on 2 or 3 stocks, like learn from those mistakes and move on. It's not over. The game is not over. You can continue on as long as you're not out of the game. So that's super key for a lot of people, because some people make these investment decisions, they lose out on like 1 or 2 stocks and then they think it's over. I lost 40%. Oh, I'm done, man. Like it sucks. They can't get back. But you only need one strong investment to make huge gains and recover all of that. And then all of that would just be forgiven. All those mistakes are just gone basically, because that one stock gave you all your returns. So, and that just goes back to finding these strong companies that are like almost monopolies that have some kind of like edge. And that's what I keep going back to, is that finding monopolies. And that's what's going to stick into my mind in this interview, is basically finding monopoly companies, making sure you're patient, you understand them, you know them, and when they go on sale, make sure you take that opportunity. And so basically that's it, man. And that's my biggest takeaways from this interview, is the monopoly situation, and just being patient, staying in your circle of competence, and just waiting for that one crazy kill that will just get you all your investment returns. You just need 4 of them, 5 of them in a lifetime, and you're successful. You made it. So that's it for the video. This is the Mohnish Pabrai interview. Go watch it. It was amazing. And like this video, subscribe to my channel, and I'll get back to you in the next video. Peace!